Giving a specific date of November 25th is incredibly confusing, Tom, but maybe it speaks to the whole thing of markets can stay irrational longer than you can stay liquid. In this post on X, he talked about some of his puts, some of his Palantir bets. Tom, how much of this is just Michael Burry confronting with a market that's incredibly hard to bet against?
The media narrative is simple. Burry is shorting Palantir in NVIDIA, but here's the subtle manipulation. The headlines said 80% of his portfolio was in Palantir puts. A lot of traders missed that this was notional value. His actual allocation, 66% of his 155 million assets under management in one short position, Palantir. This is not a balanced, data-driven move. This is a high conviction leverage bet that is way over allocated, even for a seasoned hedge fund. The biggest untold truth, Michael Burry's Scion Capital hasn't really been a hedge fund. In fact, it's been a family office, and they only have had, most recently, 4 clients. Now, the legal structure of Scion Capital is also kind of strange. Usually, the legal structure of a hedge fund would be a limited partnership. But in their case, with Scion Capital, he's using a regular limited liability company. He's saying that each of these DUDAs, the put options, lets him sell the Palantir shares at $50 in 2027. So this tweet is misleading, however. Okay, so he bought these January 2027 puts that don't expire until 421 days from now. He bought them for $1.84. Today, they're selling for about $3.22 per pop. So he made about close to a 50% profit on these puts so far. But here's the kicker. His profit is actually less than the amount of risk that he's putting himself in with these put options. Now, this is just 2 longs. We also have another long in Lululemon, which is in the consumer discretionary sector, which is been trending down right now with consumer sentiment being in recessionary lows. So not the best long to be in right now. Now let's get into the options detail that proves this is more of a roaring kitty media play than a truly superior trade. His Palantir put gives him the right to sell the stock at $50 in 2027. And Burry is betting against the Federal Reserve itself. The Fed just announced this ending quantitative tightening December 1st, 2025. They've removed over $2 trillion in liquidity since 2022, but now they're stopping the balance sheet reduction. Analysts at Evercore predict the Fed could start buying $35 billion in treasuries per month as soon as January 2026. These are multi-year options. Anything more than 120 days, generally, you're running into massive time decay risk. Now, he says that these let me sell the Palantir shares at $50 in 2027. What he means by this is because the contracts don't expire till 2027, but this is assuming that the stock is below $50 a share by the expiration of this put contract, which, as you can see, is very out of the money. Right now, the stock's at $156 a share. So this is very highly improbable that these puts are going to finish in the money by the time these expire. And we can see that the most people in these Palantir puts are at the strike joining Michael Burry. So they're just copy trading Michael Burry. And we don't know if he sold out of these puts at this point. He quoted for about a 50% profit today, which is not that great of return in the amount of risk that he's putting himself in with these puts being so far out of the money. Let's talk about his style. Operating as a net short fund, often turning into an activist short seller. Historically, this has been a notoriously difficult and often losing strategy in the long term. Many dedicated short shops have been forced to close or pivot because markets can stay irrational longer than you can stay liquid. While Burry's track record shows his strength is downside protection, his bull market performance has often lagged. His performance here is clear. A strategy built entirely on being net short against the overall market is a high-risk long-term model, not a consistent trading business. So if you had given Burry $100,000 the day he reopened the doors of Scion Capital in 2013, you'd be sitting on roughly $466,000 today. The same money in the S&P 500 would be around $380,000. Here are the 3 crucial steps I want you to start. Number 1, stop writing over what Burry thinks, says, and does. Start listening to the data for objective market signals. So For example, Nvidia being in the trend quarter over quarter of beating their earnings. So Burry is being the contrarian here. That's going against the market signals. Another example in the more macro sense is the fact that the Fed has announced they're going to do QE starting next year, it looks like. Number two, optimize your options duration. Burry's multi-year options demonstrate a deep conviction play, not a tactical options trade for most traders. Your edge comes from precise duration management, picking the optimal timeframes that balance volatility capture with minimal time decay. So you don't want to go as far out as Burry is here. You're going to run into the issue of high premiums. And the longer you go out into expiration, the more that eats into your profit potential. Now, you also want to go too short into weekly or even same day options, or else you're not going to have enough time to capture that big move. Number three, prioritize rotational volatility plays. Don't be net long or net short in this market. Burry's high correlation bets, Nvidia and Palantir, increases his risk, especially the fact that these are single puts.
NVIDIA GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong.
You're the CEO of a $4 trillion company. You don't even need words to combat a short seller. You just show the results in the earnings report. And you can literally hear the sound of Burry's entire short thesis imploding. Burry was using a 20-year-old framework, a PE ratio, a debt to equity sheet to analyze a company that is creating the entirely new foundation of a digital economy. So the value isn't in what NVIDIA is doing, but in what enables for every other company that's using their product. So this is why you must adjust your model away from the early 2000s dot-com bubble. That Burry did find success back in that day, but times have changed. Strategy should be long short as we usually do, using option spreads. This approach allows you to reduce your loss potential on each individual trade, regardless of Burry's directional bet. This is exactly what we're covering in our free 3-day live challenge starting next Friday, November 28th, Black Friday, called How Traders Turn Bubble Fears into Options Fortune. And we're going to talk about the ins and outs of advanced option spreads trading. We'll talk about index all the way to individual stock options, the differences between the two, and why you might like one over the other, or just do both. So, I'm also going to include the options trading workbook. Click the link in the description to sign up today. Drop any questions below and I'll see you in the challenge. All right, guys, so that's it for me in this video. I'll see you in the next one.